Hello, this is Jordan, and this is your Precious Metals video market update. This video is being recorded on the late evening of Monday, January 6, 2020. And normally I publish these videos or I record them on a Thursday, but because of the geopolitical news last Thursday, I wanted to wait and see how the market reacted. And given where we are today, I felt that I should publish the update today or record the update today rather than wait a couple more days because I think there's some pressing analysis to give. So in this video, I'm going to discuss the technical outlook and what looks to be the start of a short-term correction in the sector. And there's a couple reasons why I think the sector is going to start a correction, and we'll see gold join in on that, although it still leapt higher today and reached a high, I believe, of 1593. The first thing to look at is there is a very big short-term divergence between gold and the stocks. And in this chart, we have gold at the top, followed by GDX, GDXJ, SIL, and silver at the bottom. And we plot these. These are candlesticks, daily candlesticks, with the 50-day moving average. And just look at the action of the last 4 days. In the mining ETFs, you basically have 4 days of black candles or distribution. You get distribution when a market trades higher, and then you get a lot of selling that same day or week, and the market finishes lower. In other words, whether you're looking at a day or a week or a month, the market during that period, initially it has strength and gains, but then selling comes in hard, and when that period's over, the market closes at the lower end of that range. And so when we're looking at the daily charts here and looking at the last 4 days, we can see that's happened in GDX, GDXJ, and SIL. So even before the geopolitical news, the miners were tired, basically, and so we see 4 days of selling, and gold, it looks like today, Monday, you'll probably be watching this on Tuesday, but Monday, that looks like a peak in gold because gold, it gapped up. And as you can see, while it finished the day higher, it failed to close near the highs of the day. It lost most of its gains during the day. So I think that's probably going to be the top for gold. If it's not, we'll probably see the top, within hours. So that's basically the situation here. This is all pointing to a short-term peak and a correction. And just two last things. If you look and see how these markets, they're quite a bit above their 50-day moving averages. So the short-term momentum has been, to this point, or at least till 3 or 4 trading days ago, the short-term momentum has been pretty strong. GDX is almost 2 full points ahead of its 50-day. GDXJ more than 3 points, roughly 10% or 7% or whatever it is above its 50-day moving average. So, and another thing which I'll talk about later is if you look at GDXJ and GDX, they did hit some long-term technical resistance, but that'll be later in this update. Also, breadth indicators. Now here I plot GDX and I look at the Huey breadth indicators because the stocks in the Huey, they don't change that often. And with GDX, there's royalty companies in there, and they change the companies that are in the index quite a bit. So I just wanted to keep it simple and look at the breadth of the Huey, and I'm tracking the percentage of the Huey stocks that closed above the 200-day, the 50-day, and then at the bottom the 20-day. And by the way, the Huey is basically GDX but without the royalty companies. So we're looking at gold producers, gold miners only. And look at the blue arrows. A couple trading days ago, the entire Huey had closed above the 20-day and also the 50-day. So that is extreme strength with respect to those indicators. In the 200-day, that was up close to 90%. So strength is a good thing. This is what we want to see. But when you have those short-term readings up at 100%, the market is fully overbought on a short-term time frame. So that's what we're seeing here. And I mean, that's another reason why we're going to see a correction. But also, we see something similar with GDXJ. Is not quite as strong, but if you look at the two rows, not the first one, which is the percent of GDXJ above the 200-day, I mean, that's at 83%, which is relatively high. But above the 50-day, a couple days ago, you had 90% of GDXJ above the 50-day, and you had 100% above the 20-day. So not quite as strong as the Huey, but still a huge amount of short-term strength. And if you look at the top there, GDXJ traded up, I think, close to 43. It was battling with 42. 42 has been resistance dating back not just to 2016, but you'll see in another chart, it was resistance, I think, in 2013, 2014. So a lot of reasons to think the market is going to correct here. The gold COT, that data has been making the rounds on Twitter today. Gold, obviously, it was able to close above the September peak, but again, I think it probably peaked today. The net spec position as of last Tuesday was at 46.6%. Expect the reading that we get on Friday. That's probably going to come in pretty hot. I'd be surprised if it was not at least at 49 or 50%. Now, and I'm measuring the net spec position against open interest because you can look at the bottom and see there, it gives us a consistent look over time. I mean, we're hearing, all-time high and the net spec position. And I mean, that's accurate, but if you measure it against open interest, which gives us a consistent look over time, that's not accurate. And if we're looking at, where the peaks in the net spec position have occurred over time, the major peaks tend to be at 55 to 60%. So that's important to keep in mind. And I highlighted in blue in the 2000s points when the net spec position was really hot. It was at the extreme, but look what happened. I mean, in some cases, the market corrected a little bit. In other cases, it had a correction for less than a month, and then it just kept going higher. So there's a difference between bullish sentiment in a bull market and bullish sentiment in a bear market. And look in red at gold's peaks in 2011, 2012, and 2016. Those peaks were at 55% or very close to it. And you can see that, there were serious declines after those peaks because gold was not in a full-blown bull market like it was in the early 2000s and like it probably is now. So I'm not that worried about the COT beyond the next couple weeks or the next month or two. Aside from that, in the short term, if you think gold is in a new primary bull market, then don't worry about the COT. For gold to keep moving higher, eventually we need more and more speculators to buy. That's just how it works. And occasionally, there will be times if the market's really hot where the commercials actually have to cover. So that can also happen. So just keep this in mind. It's not a death sentence for gold as long as gold remains in an uptrend, which I think it will. Oh, and last point on that, I do hope that we can, I'll just go back for a second. Like I said, the next reading is probably going to be around 50%. If we get a correction for a month or two, it would be great to see that position come down to 40% or the high 30s. That would really be great to clear out some of the specs. Now, this is always my favorite chart, which I include in these videos, and I stopped myself for a second because I can put in the correct chart later, but I realize I have the wrong chart here. But yes, this is one of my favorite charts. But if we look at GDX, obviously the big resistance is around 31, but there's also some resistance at 30. If you look carefully, just going back over the last 6.5 years, and I already noted with GDXJ, there is some resistance around 42. That goes back to 2014. So those are long-term resistance levels where the miners peaked in recent days. So again, that's another reason why I think we're going to have a short-term correction here, but nothing that severe. So with that said, I thank you so much for tuning in today. Please go to thedailygold.com. You can check out all my work there. Consider subscribing to my premium newsletter. It's highly affordable, only $149 for 6 months. Go to thedailygold.com/premium. We focus on market timing and stock selection. And listen, guys, if you have some cash, I have a little bit of cash left. The weeks ahead, it's looking like it's going to be a time where we can buy or accumulate companies on weakness. It looks to me like we're going to see lower prices, and that is a good thing because you can buy in at better prices rather than chasing things, because chasing is never good. So if you missed the recent rally or you want to shift around your holdings and get into the best things, they look like they're correcting now. So the next couple weeks could be a good chance to be a buyer. Consider subscribing to our publication. Thank you so much for listening to this video. I really appreciate it, and I look forward to doing another video update for you guys in the weeks ahead.